So the headline has it, unemployment is at 3.5%. Hi, I'm Beata Bukowski, Fairway Independent Mortgage, coming to you yet with another weekly economic update. So yes, the headline is at 3.5, but what's really the bottom line? Bottom line is that there is a ton of people that have not been employed and have not been looking for a job in the last 4 weeks. So the U6, which is the unemployment rate that includes all people without a job, represents more like 6.7%. The job creation sector says that there were 528,000 jobs created. That is almost double the number that economists have predicted. So as you see it, it looks like we are doing well. But there is some additional recessionary red flags that I'm going to cover in just a moment. The home price and home appreciation front, CoreLogic has reported that property values rose 0.6% in the month of May for an annual rate of 18.3, which is down from 20% just a month before. CoreLogic forecasts that home prices will appreciate another 0.6% in July and 4.3% going forward, 4.3%. So anybody buying today shouldn't anticipate 4.3% increase by the same time next year. To those recessionary pressures and red flags, well, number one is the unemployment rate. The unemployment rate will keep dropping, which it has effectively, until it starts ticking up a little bit on the continued claims and on the brand new claim. When that happens, that's one of those red flags to be known. Second red flag we've been already in full swing of it, the Fed rising Fed fund rate. They've done it already in March, April, June, and July for a total of over 1.5%. And now, because of the strong employment data, the Fed has commented that they're looking to yet increase the Fed fund rate again in September at their next meeting. The inverted yield curve we've also talked about. That's when short-term bonds yield a better return, higher interest rate than the long-term, and we're talking typically 2-year versus 10-year bond. That inverted yield curve typically is the onset of recession. Number 4, overheating economic sector where demand can't be sustained. Once that demand gets back into normal, people will be laid off because less production will be going forward. Lastly, and that's the 6th flag, we refer to it as leading economic index. Leading economic index, typically in all of the recessions in the past, has been a very solid indicator of recession. The only way this could change is if mortgage interest rates fall back down and the housing market will come to the rescue. Increased demand, lower interest rates, higher affordability will bring things maybe to not a complete halt, but slow down under recessionary pressures. That's all I had for you today. Beata Bukowski, over and out.